Hello everyone and welcome back to the sessions on financial reporting. Friends, in this class we are continuing with the topic Ind AS 116 leases. Let me remind you, this is the third lecture on leases. Friends, in the earlier sessions we have been talking about important terms and definitions within the standard, and now time has come for you to understand the core accounting aspect. Now friends, this is very simple if you can approach this topic logically. Approaching this topic logically means you understand one party's perspective at a time and try to deal with all possible scenarios. So just imagine we are talking about lessees, and if there is a short term lease or lease of a low value asset, the lessees are exempted to apply the requirements of Ind AS 116. Do you remember what we have learnt? Whatever payments are made for short term leases or for lease of low value assets where the exemption is availed by the lessee, the lease payments are simply charged off as an expense on a straight line basis or on some other appropriate basis in the statement of P&L as expenses. That's all. Nothing as such is required by Ind AS 116 over such accounting. Short term leases or leases of low value assets, matter is over. Now, if the lease is not a short term lease or not a lease of low value asset, then you have to look into the detailed accounting requirement as per Ind AS 116. So what happens? The lessee will simultaneously recognize two components at the commencement date. So we have learned what is inception date, what is commencement date. At the commencement date of the lease, where the accounting begins, I have told you earlier, accounting begins not at the inception date but at the commencement date. Inception date was simply a date at which the two parties have entered into the contract, and commencement date is the date from which the lease actually begins. So accounting also begins from the commencement date. So the lessee who is not taking exemption of short term leases or lease of low value assets, or you can say leases which are to be accounted for in entirety as per Ind AS 116. For those leases, the lessee is required to recognize two things simultaneously at the commencement date. Number one, an asset with the name right of use asset. So the nature of the asset will not be any building, equipment or plant and machinery. Whatever you have taken on lease, that asset doesn't become your asset. So you have suppose taken a car on lease, in your balance sheet you will not recognize the car. What you will recognize is right of use. The nature of that asset will be ROU asset, it will be right of use asset. As a result, it will not be treated by any other standard, it will be treated within this Ind AS 116 as per the requirements of this standard only. So the nature of the asset will be ROU asset, that is right of use asset, and the corresponding liability that will be recognized will be simply called as a lease liability, and the nature of that liability is the amount which is payable to the lessor. Now when you are recognizing this ROU asset and the lease liability at the commencement date, you need to recognize these two amounts based on the present value of future lease payments. So all the lease payments that are defined under the standard as lease payments should be considered, and then you will take the present value of those lease payments, and based on the present value you are going to determine two things: right of use asset and lease liability. But friends, before you determine those present values, you should know what are lease payments, what all payments are included within the term lease payments, and what are the payments that should not be included within lease payments. So friends, this point of discussion about lease payments is the focus point of today's class at the beginning part. Let us first understand what are the lease payments. Lease payments will be comprising of certain elements. Let us discuss these one by one. First will be fixed lease payments or lease payments which are in substance fixed lease payments. So the first point over here is fixed lease payments or lease payments which are in substance fixed lease payments. Friends, each of these components I am going to discuss in details later, but as of now you at least try to understand the brief meaning of each component. So fixed payments are those payments which are determined at the beginning. That means you are known to have exactly that much payment. Those are fixed payments. Now fixed payments need not necessarily be the constant amount each year. It may be this way, that if the lease term is 3 years, the lease rental will be 1 lakh per month for the first year, 1,10,000 per month for the second year, and 1,20,000 per month for the third year. This also will be considered as fixed lease payments because these are defined at the commencement date. Let us now talk about what are in substance fixed lease payments. These are the payments which may appear to be having variable component included, but in substance they are fixed lease payments. For example, if the lease payment is rupees 1 lakh per month for the first year and the lease payments are supposed to increase by 10% every year compared to previous year's rental. So if it is 1 lakh per month in the first year, it will be 1 lakh plus 10%, that is 1,10,000 per month in the second year. It will be then 1,10,000 plus 10%, that will be 1,21,000 per month in the third year, and so on. Now do you understand that even though the increase is given in terms of percentage, but it is still considered as a fixed lease payment, it will better be classified as in substance fixed lease payments. Friends, when we go into details of that component, that is in substance fixed lease components, we are going to talk more about that along with some examples. So I am still into the first point of component of lease payments. So the first point I would say, it is fixed lease payments or in substance fixed lease payments as reduced by the incentives given by the lessor to the lessee, which we can call as lease incentives. Again, I will be talking in details about lease incentives. However, right now my objective is you should get an idea of what are the components of lease payments. So first thing I have discussed. Second point, variable lease payments are also part of lease payments, but not all variable lease payments. Variable lease payments which you should consider are variable lease payments that are linked with or dependent on any index or rate. So we have to divide variable lease payments into two categories. One that depend on any index or rate, another that do not depend on any index or rate, rather they depend on the usage of the asset. So those lease payments which are dependent on any index or rate, only those lease payments will be considered as part of the lease payments. The lease payments which are variable and do not depend on the index or rate and depend on some other factor, they will not be considered as part of lease payments. So friends, I told you very clearly we are going to discuss each component in details little later. Third component, that is if the lease is offering a purchase option, that is when the lease term is over, the lessee has a right to buy the asset, then the amount payable under the purchase option will also be part of the lease payments, provided the lessee is reasonably certain to exercise that purchase option. Fourth thing, if there is any termination penalty, then that termination penalty amount shall also become the component of lease payment, provided it is reasonably certain that the lessee will terminate the lease before the lease term expires. So, for example, the lease is of 5 years and the lessee has a right to terminate the lease after 3 years. So, the first 3 years is a non-cancellable period, but at the third year end, lessee can exercise its right to cancel the lease or terminate the lease. But the lessee is supposed to make a penalty payment of rupees 1 lakh if the lessee wants to terminate the lease after 3 years. So, what will happen? At the commencement date, you have to look into whether there is reasonable certainty that lessee will terminate the lease after 3 years. If yes, then include that 1 lakh of payment as part of the lease payment. If no, then just ignore it. And friends, I told you earlier, if there are any changes in our estimates, we will deal with that later when we go with the remeasurement and reassessment part. So friends, I have just discussed 4 components which are to be considered under lease payments. There are some components which will not be considered as lease payments. Let me clarify even that. Number 1 was variable lease payments which do not depend on any rate or index, that will not be part of lease payments. And if there is any non-lease component included within the contract and some payments have been allocated to that, obviously that being a non-lease component, the name non-lease component says it is not a lease component, so it will not be considered under lease payments. And friends, above all these components, there is one more thing that I am not discussing right now. I would just want you to identify that as a component of lease payments, that is residual value guarantees. As of now, I am just giving a briefing of that. Residual value guarantees. Simple point is, if I have taken an asset under a lease from you, you are lessor, I am lessee. Don't you agree that you would expect that I should properly handle the asset? If I have to give back the asset after 2 years, and if I don't maintain that asset properly, you will find loss in value of that asset, and you as an owner of the asset will be losing out. Therefore, you would ensure that when I return back the asset should have a specified amount, a definite amount where it would realize or it would recover that much amount at the date when I return the asset to you. If there is any shortfall in that value, you should have right to recover that from me, and I will be under obligation to pay that amount to you. In such cases, that amount which is payable by the lessee to the lessor will be considered as the residual value guarantee from the viewpoint of lessee. Friends, we have this point to be discussed in details, and where I will show you the perspective of lessor, which is little different. However, my focus right now is to make you write down these important notes, and then we shall start discussing each of these elements in details. So friends, what we have just discussed about lease payments. Lease payments are defined as payments made by a lessee to a lessor relating to the right to use an underlying asset during the lease term, comprising the following. Number 1, fixed payments, including in substance fixed payments, less any lease incentives. So friends, as I told you, we are going to discuss in details about these fixed payments, in substance fixed payments and lease incentives. We are going to discuss about this in details definitely. The next point over here is variable lease payments, but the condition is that depend on an index or rate. So it is implied that variable lease payments that do not depend on an index or rate will not be part of the lease payments. Third, the exercise price of a purchase option if the lessee is reasonably certain to exercise that option, and then payments of penalties for terminating the lease if the lease term reflects the lessee exercising an option to terminate the lease. So friends, I have already explained you this. Quickly take note of all these points. Alright friends, you would have finished writing this whole thing. Let us move ahead and write up the note about the residual value guarantees. For the lessee, lease payments also include amounts expected to be payable by the lessee under residual value guarantees. For the lessors, lease payments instead includes residual value guarantees provided by the lessee, a party related to the lessee, or a third party unrelated to the lessor that is financially capable of discharging the obligations under the guarantee. So friends, note down these points as well, and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and now talk about exclusion of payments for calculating lease liability. For the lessee, when you are computing lease liability, we have already discussed this point. Lease payments do not include payments allocated to non-lease components of a contract unless the lessee elects to combine non-lease components with a lease component and to account for them as a single lease component. That is, the lessee using the practical expedient of reporting everything as a single lease component that we have learnt in the second lecture. Now, the other point over here which will not be part of the lease liability, again that thing you already know what we have discussed, variable lease payments that do not depend on index or rate. So friends, write down this as well and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and now talk about fixed lease payments in details. Now friends, understanding fixed lease payments. The definition of fixed lease payments in the standard, that is under Ind AS 116, is given as all the lease payments which are made by lessee to the lessor excluding the variable lease payments. That means all payments other than variable payments will be considered as fixed lease payments. That is how the definition of fixed lease payment appear in the standard. So all lease payments minus variable lease payments, or I would say all lease payments excluding variable lease payments, that will be considered as fixed lease payments. Now friends, when you are trying to understand fixed lease payments, in simplest words I would say all such payments that are definite amounts and such amounts are known at the commencement date will be considered as fixed lease components or fixed lease payments. So I have given you examples earlier. If there is a fixed amount of rent, every year the monthly rental will be 1 lakh per month for 5 years, fixed lease payments. Every year the lease payments will increase by 10,000 every month. So if it is 1 lakh per month at the first year, it will be 1,10,000 per month in the second year, it will be 1,20,000 per month in the third year, and so on. It will be an increasing pattern with differential of 10,000 every year on year basis. It can be a third situation where the rent will be 1 lakh per month in the first year. In the second year, the rent per month will increase by 10%, that is 1,10,000 per month. Then in the third year, the rent will further increase by 10%, so that will be 10% added on 1,10,000, it will become 1,21,000 per month. So it can be either a constant amount throughout the lease term, or it can have a defined pattern of increase or decrease, and that defined pattern of increase or decrease can be either by adding some constant amounts or by adding certain percentages, where those amounts and percentages are very well defined and known at the commencement date. Then these payments will be classified as fixed lease payments. So let us write up a note about this. So friends, what we have just talked about fixed lease payments, that these are defined as payments made by a lessee to a lessor for the right to use an underlying asset during the lease term, excluding variable lease payments. And fixed lease payments can either be a fixed amount paid at various intervals in a lease. For example, a 5-year equipment lease with an annual lease payments of rupees 20,000. This can be considered as an example of fixed payments. Alternatively, these can be payments that change over time. So payments changing over time can also be considered as fixed lease payments. For example, lease payments of rupees 20,000 per month at lease commencement that increase annually by rupees 2,500 per month. So friends, we have already discussed these points, just need to write it down. So quickly note it down and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and apply this concept on a question, that is question number 22. Let us read this question. Entity M and lessor A entered into a 10-year lease of an office building for a fixed annual lease payment of rupees 2 lakhs. As per the terms of the lease agreement, annual fixed lease payments comprise of rupees 1,70,000 for rent and rupees 30,000 for real estate taxes. What are the fixed lease payments for purposes of classifying the lease? Now friends, over here, to understand the whole scenario, you first need to identify one very simple thing, that 1,70,000 is purely the payment towards rent and 30,000 is a payment towards real estate tax. You will find that we don't see any non-lease component over here. We have learned one thing in the earlier classes, that property taxes or generally taxes on assets and the insurance component, which are fixed by nature, they are themselves allocated over lease and non-lease component. So this 30,000 of real estate tax could have been ideally allocated over lease and non-lease components. However, we do not find any non-lease component over here. So this is a lease component and therefore this whole 30,000 will be part of this lease component itself. This is fixed, this is fixed, so the total fixed lease component will be rupees 2 lakhs. In simple words, if the question is asking you what are the fixed lease payments for the purposes of classifying the lease, we will say entire rupees 2 lakhs will be considered as fixed lease payments. So let us see how to write up the answer. In your answer, you would first mention the fact that fixed lease payments are rupees 2 lakhs. Although real estate taxes are explicitly stated in the lease contract, they do not represent a separate non-lease component as they do not provide a separate good or service. The right to use the office building is the only component and therefore the annual lease payment of rupees 2 lakh represent payments related to that single lease component. So friends, do one thing, write up this answer and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and now talk about what are in substance fixed lease payments. So what are in substance fixed lease payments? These are the payments which may appear to be variable or contingent, but that is just by the appearance or by their form. In substance, these are still fixed lease payments. Now there can be varieties of examples. So let me give you some examples so that you are able to understand this point very well. Now friends, in reality, when I started my own classes long back, it was year 1997. What happened? I was not sure of how many students would turn up, and I remember in my small town, when I wanted to take a small premises on lease, it was just a rent of rupees 2000 per month, but that was such a heavy amount for me at that time. I was not confident about what would happen. Now, the person from whom I was taking this premises on rent was the same person who suggested me that I should carry out this business on a little larger scale. What that person suggested, that you take my premises on rent. If there is any number of students less than 10 students, don't pay me rent or pay me less rent. Pay me rent whatever you would feel like. Only when the students are 10 or more, then you pay me the usual rent of 2000 per month that we have agreed. In that lease contract, there was a relaxation that if I could secure less than 10 students, the rental paid will be proportionately reduced, or if there are no students, it will be waived off. But the supplier of the premises, the landlord, knew one thing, that there will be definitely 10 plus students, and therefore there is no question of variability coming into picture. Right from the first month, he knew that he is going to get rupees 2000 every month. Even I had that bit of confidence that yes, maybe that I can start. But friends, I still remember that fellow, and I still owe him a big thanks for one thing, because if that kind of relaxation wasn't given to me, wasn't offered to me, I would not have taken that place on rent at all, and this all would not have started. So if I have to draw a conclusion from that real life example, if you can still look into the nature of agreement, it had variability, right? It had variability. That means if there are less students, the landlord was okay to receive lesser amount of rent. So that means that makes the nature of rent payable or the lease payments as variable. But because there was a genuine possibility of having more than 10 students throughout, it was known that the rent would be rupees 2000 every month. And therefore, even though in the contract it appeared to be a variable payment, but in substance there was a fixed lease payment always involved. So friends, I would want you to write some important notes about this, and I will give you some more examples through those notes. So what we have just discussed about in substance fixed lease payments, these are the payments that may in form contain variability, but that in substance are unavoidable. Examples of those types of payments include payments that must be made only if an asset is proven to be capable of operating during the lease, or only if an event occurs that has no genuine possibility of not occurring, or payments that are initially structured as variable lease payments linked to the use of underlying asset, but for which the variability will be resolved at some point after the commencement date, so that payments become fixed for the remainder of the lease term. So friends, we have already discussed these points. You just need to write it down. So I am giving you time, quickly note down these points. Alright friends, you would have finished writing these notes. Let me give you one more example for better understanding. Suppose I have taken a truck under a lease and the lease rental or lease payment for the first year is rupees 2 lakhs. Now the contract includes a clause that in the second year the rent will increase. So the second year's rent will be either 5% more than the first year's rent, that means either it will be 2,10,000 or it would be 10% of my gross revenue of first year if my gross revenue in the first year exceeds rupees 30 lakhs. So if the gross revenue exceeds 30 lakhs, suppose it goes to 32 lakhs, then rent will be 10% of 32 lakhs, rent will be 3,20,000. So as per the terms of the contract, rent will be 2,10,000 or 3,20,000, whichever is higher. Now this is the contract. I have to identify how much of this is in substance fixed lease payment. So with respect to first year, there is no doubt 2 lakh is in substance fixed lease payment, or you can simply call it fixed lease payment. In the second year, I have to look into, should I consider 2,10,000 or 3,20,000? That is the question, right? So if I assess what is the possibility that I will be able to generate 30 lakh plus revenue in the first year, I find no genuine possibility of that. That means I find my revenue exceeding 30 lakhs is an unrealistic situation. The moment I find it unrealistic, I will just knock it off. What I will consider is only the realistic part, and the realistic part does not create any confusion. It is very clear. It will be 5% more rentals as compared to the first year. So now the 2 years rental payments or lease payments are clearly defined, 2 lakh in the first year and 2,10,000 in the second year. So if there are multiple bases, I will consider only the realistic one out of the available bases. Now you might have a doubt in your mind that what if in this example that I just gave you, revenue exceeding 30 lakhs was unrealistic? What if it was realistic? That means 5% increase is a realistic possibility. Achieving 30 lakhs of revenue in the first year is also a realistic possibility. If both are realistic, then what? If both are realistic and I have to pay one of these two definitely, in fact as per the contract I have to pay higher of the two, but Ind AS 116 is very clear in this regard. Between the two, whichever is of a smaller amount will be considered as in substance fixed lease payment. If at all I have to pay something more because of the variability included, that excess amount will be charged off in the statement of profit and loss when it is incurred. In that case, I would conclude that if there are multiple realistic possibilities, I have to take the lower of the possible values as in substance fixed lease payments. So friends, let us write down those important points that we have just discussed. If there is more than one set of payments that a lessee could make, but only one of those set of payments is realistic, in such a case, an entity shall consider the realistic set of payments to be lease payments. If there is more than one realistic set of payments that a lessee could make, but it must make at least one of those set of payments, in such a case an entity shall consider the set of payments that aggregates to the lowest amount on discounted basis to be the lease payments. If payments are structured as variable lease payments, but there is no genuine variability in those payments are in substance fixed lease payments. So friends, these points also we have discussed. Just note down these quickly and then we shall move ahead and apply this concept in solving some questions. Alright friends, you would have finished writing this whole thing. Let us move ahead and solve question number 23. Let us see what is given over here. Entity Q enters into a 7-year lease for a piece of machinery. The contract sets out the lease payments as follows. If Q uses the machinery within a given month, then an amount of 2000 accrues for that month. If Q does not use the machinery within a given month, then an amount of 1000 accrues for that month. What is considered as lease payments in this case? Now, in order to analyze this whole situation, what you can do is observe one thing. There are two different types of payments that can be made, either 1000 per month or 2000 per month. 2000 per month is payable when the machine is used. 1000 per month is payable when the machine is not used. So what happens? This part is unavoidable, correct? 1000 per month you have to pay whether you use the machine or not. However, out of this 2000 per month, only 1000 is payable when the machine is not used. That means for using the machine, the additional payment would be 1000. Now this part of the variability is not dependent on any index or any rate, correct? This part of variability is only for the use of the machine over and above the lease payment of 1000 per month. So what we can say is the fixed lease payments over here will be 1000 per month, full stop. Whichever month the machine is used, that month there will be an additional payment of 1000 for that month. So 1 plus 1, it will be 2000 accruing for that month. That extra 1000 will be charged off as an expense of that month, that's all. So for the purpose of lease liability computing, we will consider only 1000 per month as in substance fixed lease payments. Let us see how to present the answer. Q considers the contract and notes that although the lease payments contain variability based on usage and there is a realistic possibility that Q may not use the machinery in some months, a monthly payment of 1000 is unavoidable. Accordingly, this is an in substance fixed lease payment and is included in the measurement of lease liability. So friends, quickly note down this answer and then we shall move ahead and solve more questions. Alright friends, you would have finished writing this whole thing. Let us move ahead and now take up the next question, that is question number 24. Let us read this question. Entity P enters into a 5-year lease for office space with entity Q. The initial base rent is rupees 1 lakh per month. Rent increases by greater of 1% of entity P's generated sales or 2% of previous rental rate on each anniversary of the lease commencement date. What are the lease payments for the purpose of measuring lease liability? Now, analyzing this situation is again very simple. What we can find is the initial rent rate is rupees 1 lakh per month for the first year. Second year onward, the rent will definitely increase. The increase could be either by 1% of sales or by 2% of the previous rental rate, whichever is higher, because we have been asked to consider the greater of the two. Now you assess yourself, this 1% of sales generated in any year cannot be ascertained at the beginning or at the commencement of the lease. One thing is for sure, between these two, whether the sales are known or not known, minimum increase in the rent will be 2%. So if the rental rate for the first year was 1 lakh per month, the rental rate for the second year has to be at least 1 lakh 2000 per month, that is 1 lakh plus 2%. As a result, this 1% will not be considered initially for determining the lease liability. So friends, let us see how to write up the answer. In the given case, the lease payments for purposes of classifying the lease are fixed monthly payments of rupees 1 lakh plus the minimum annual increase of 2% of previous rental rate. Entity P is required to pay no less than a 2% increase regardless of the level of sales activity. Therefore, this minimum level of increase is in substance fixed lease payment. So friends, quickly note it down and then we shall move ahead solving other questions. Alright friends, you would have finished writing this whole thing. Let us move ahead and take up the next question, that is question number 25. Let us read this question. Company N leases a production line. The lease payments depend on the number of operating hours of the production line, that is N has to pay rupees 1000 per hour of use. The annual minimum payment is rupees 10 lakhs. The expected usage per year is 1500 hours. So friends, in this case, how would you analyze the case and how would you consider the lease payments? Very simple. 1000 per hour and the expected usage is 1500 hours. So rupees 1000 per hour multiplied by 1500 hours will make the calculation of lease payments to 15 lakh rupees for the year. However, if you consider 15 lakhs as the total expected lease payment, the minimum payment is 10 lakhs. That means 10 lakhs is the minimum amount of lease payment, which is fixed lease payment. Additional 5 lakh rupees that you will have to pay could be a variable part of the lease payment, and that variable part of the lease payment is not linked to any index or rate. That means it is not dependent on any index or rate. As a result, that 5 lakh will not be included as part of the lease payments. Lease payment will only include the minimum fixed lease payment of rupees 10 lakhs. So let us see how to write up the answer. The lease contains in substance fixed payments of rupees 10 lakh per year, which are included in the initial measurement of the lease liability. The additional rupees 5 lakhs that company N expects to pay per year are variable payments that do not depend on an index or a rate but usage. So the lease payment will be only and only rupees 10 lakhs. So please write up this also and then we shall move ahead. Alright friends, you would have finished writing this answer. Let us move ahead and talk about the next concept, that is lease incentives. Now friends, lease incentives are basically payments made by the lessor to the lessee. The moment I say this line, you will have a doubt in your mind, why is lessor making a payment to the lessee? Try to understand this important thing. Assume in an example that I have approached a property owner for taking their property under a lease. So sitting across the table, we have negotiated the terms. I said, okay, fine, I am ready to pay rent of rupees 2 lakh per month for a total lease period of 3 years, and I shall pay a deposit of rupees 20 lakhs. But I don't want to take the premises right now. I would want to take it after a month. Right now we are in the process of shifting our office, so right now I'm held up with that work. I will definitely take your premises after 1 month. That means I'm considering the date of contract as an inception date, and I'm promising the counterparty that commencement of the lease will be after 1 month. Lessor or the supplier has no problem with that, but the supplier is having a risk. What if I don't turn up after a month and take the premises actually on lease? So this was just a verbal agreement, no contract written, but the supplier, the owner of the property, wants some assurance. So owner of the property is demanding 1 lakh upfront payment. That means rupees 1 lakh should be paid upfront. I would pay that money so that the contract is secured from the perspective of both the parties. Generally, this is considered as a token money. But boss, if I have given this token money, it is not a premium that I have paid. I want to get it back. Either this has to be considered as part of the deposit, or this has to be considered as an advance payment of rent or lease payment, whatever it is. Now the lessor, the supplier says that you pay me 1 lakh rupees today and I shall provide you an incentive of 80% of this amount the day the lease commences. So why 80%? For this 1 month, it is the supplier who is losing out the opportunity of earning rent, correct? So supplier also needs some compensation for that. So I have agreed that okay, I am making an upfront payment today. After 1 month, when the lease commences, you give me back 80,000. That day when the lease commences, lessor would pay back to me. I am lessee, I will get back that payment from the lessor, and this will be classified as a lease incentive. So basically, lease incentive may not be necessarily taking this kind of situation, it can be other situation as well. For example, I have my office located at some other place. I will incur cost for shifting the whole premises over here. That means shifting the whole infrastructure into this new place will cost me something, and because the lessor is getting an opportunity to getting started with some lease income, some lease rental income, the lessor offers one thing that okay, whatever be the cost of shifting your business from the old place to this new place which you are now taking under lease from me, 50% of the cost I will pay you. That means now the lessor pays to me my expenses to the extent of 50%, where those expenses are relating to shifting of my business facility from old premises to this new premises. This is again another example of lease incentives. So let us do one thing, let us write up some notes about this point, lease incentives. So friends, based on what we have just discussed about lease incentives, we can conclude these are payments made by a lessor to a lessee associated with a lease, or the reimbursement or assumption by a lessor of costs of a lessee. For the lessee, lease incentives that are paid or payable to the lessee by the lessor are deductible from lease payments and reduce the initial measurement of lessee's ROU asset. So friends, we have already discussed these points, just note it down and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us now understand the lease incentives from the perspective of lessor. So write the lessor's points. So for lessors, lease incentives are also deducted from lease payments and affect the lease classification test. If it is a case of finance lease, we would write for finance leases, lease incentives reduce the expected lease receivables at the commencement date and thereby the initial measurement of lessor's net investment in the lease. For operating leases, lessors should defer the cost of any lease incentives and recognize that cost as a reduction to lease income over the lease term. So friends, write down these points as well and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and now talk about variable lease payments. Let us now have discussion about variable lease payments. Variable lease payments are defined as that portion of lease payments made by the lessee to the lessor which are subject to variation. That means these payments will vary due to changes in facts and circumstances that arise after the commencement of the lease other than passage of time. So if I repeat that definition, variable lease payments are that portion of the lease payments made by the lessee to the lessor that varies because of changes in facts and circumstances that arise after the commencement of the lease other than passage of time. Now this other than passage of time is the important set of words in this whole definition. Let me explain this by example. Suppose I have negotiated a lease contract with you. I am lessee, you are lessor. I have agreed to make lease payments as follows: 1 lakh first year, 1 lakh 10,000 second year, 1 lakh 20,000 third year. Is this fixed lease payment or variable lease payment? Rent is changing each year. That is a fact what we find. So there is variation, correct? You cannot deny there is variation. But what is causing this variation? Only thing that is causing this variation is the passage of time. So in the first year I am paying rent of 1 lakh. What will make this change? Only one thing, passage of time. If the time passes, the rent for the second year will be 1 lakh 10,000. The moment the variation is arising because of passage of time, it will be not classified as variable lease payment but will be considered as a fixed lease payment only. However, if it is for factors other than passage of time, then it can be considered purely variable. For example, if I say that I am lessee, you are lessor, I am paying rent of 1 lakh every year for the entire term of lease. However, this 1 lakh per annum rent is based on the consumer price index prevailing today. So today, if we look into what is the consumer price index for this example, suppose it is 250. So 250 is the consumer price index on the commencement of the lease. Fine. First year I will pay rent of 1 lakh. By end of first year, the index changes to 272. So what will be the lease payment for the second year? Simple logic of proportion you apply. When the index was 250, lease payment was 1 lakh. When the index is 272, what should be the lease payment? 250, 1 lakh, 272, how much? So what would you do? You will work out by taking 1 lakh into 272 divided by 250. The resulting amount has to be paid for the second year. Now this change has occurred for factors other than merely passage of time. Because the index has changed, the rent has changed. If the index would not have changed, the rent would not have changed. If the index would have dropped, the rent would have reduced. The point is what? Your rent payment or lease payment is dependent on that consumer price index and not just dependent on the passage of time. So friends, when the nature of the lease payment is varying because of the changes in facts and circumstances that arise after the commencement of the lease other than passage of time, will be considered as variable lease payments. Now, as per the standard, the variable lease payments shall be divided into two categories: those which are dependent on some kind of index or rate. You can say an example of rate like LIBOR. So if certain kind of payments are linked with floating interest rate, and because of the changes in interest rate, if the amount of lease payment changes, we can say that the variation in the lease payment is subject to or is dependent on changes in those rates. So changes in consumer price index, changes in rates can be considered as one category of variable lease payments. The other category of variable lease payments will not be part of lease payments. That is something very, very important. Let me give you an example. Suppose I have taken a car on lease and the lease rental for the car is rupees 80,000 plus rupees 2 per kilometer. So you identify what is the lease payment, how much I have to pay to the lessor. First year it is 80,000 plus rupees 2 per kilometer. So whatever be the number of kilometers the car is operating multiplied by 2, that much amount I have to add to 80,000 and then make the payment. Now this time the lease payment comprises of a fixed payment and a variable payment. The fixed payment is definitely part of lease payment, and the variable payment is not dependent on any index or any rate. It is in fact dependent on usage, and as per Ind AS 116, that type of variable lease payment will not be considered as lease payment at all. That means for computing the lease liability at the commencement date and the computation of right of use asset for the lessee, both of these will be done without considering that variable lease payments which was based on usage. So how would you treat that? It's a simple thing. When that expense arise, you will charge it off to P&L. Don't record it right now under your lease liability. So the point is very simple. If the variable lease payments are varying because of changes of consumer price index or some kind of rates, then it will be considered as part of lease payment. If the variation is arising because of usage of the asset, then such variable payments will not be part of lease payments. So friends, let us do one thing. Let us write up notes about this important point, variable lease payments. So friends, based on what we have discussed about variable lease payments, we can conclude by writing variable lease payments that depend on an index or a rate. Now these are definitely part of the lease payments. So variable lease payments are defined as the portion of the payments made by a lessee to a lessor for the right to use an underlying asset during the lease term that varies because of changes in facts or circumstances occurring after the commencement date other than the passage of time. These may include payments linked to a consumer price index, that is CPI, payments linked to a benchmark interest rate such as LIBOR, payments that vary to reflect changes in the market rental rates. So friends, we have already discussed these points. Just quickly take note of these. Alright friends, you would have finished writing this whole thing. Let us move ahead and write down something more about this. Such payments are included in the lease payments and are measured using the prevailing index or rate at the measurement date. Despite the measurement uncertainty associated with the changes to index or rate based payments, the payments meet the definition of an asset for the lessor and a liability for the lessee because they are unavoidable and do not depend on any future activity of the lessee. Lessees frequently remeasure the lease liability if there is a change in the cash flows for future payments resulting from a change in index or rate used to determine lease payments. So friends, note down this thing as well, and then we shall move ahead and solve questions. Alright friends, you would have finished writing these points. Let us move ahead and apply this concept on question number 26. Let us read this question. An entity enters into a 10-year lease of property. The lease payment for the first year is rupees 1000. The lease payments are linked to a consumer price index, that is CPI, that is not a floating interest rate. The CPI at the beginning of first year is 100. Lease payments are updated at end of every second year. At the end of year 1, CPI is 105. At the end of year 2, the CPI is 108. What should be included in lease payments? So friends, analyzing this situation is again a very simple task if you have understood the requirements clearly and correctly. So if you could see, there is a relationship of this lease payment with the consumer price index. And have you noticed one thing, that the change in the rent will be after every second year, because lease payments are updated at end of every second year. That means once you fix a lease payment, it will be applicable for a couple of years, 2 years. So initially rent fixed was 1000. You can say rent or lease payment fixed was 1000 for the first year, and the base index was 100. So even though CPI has changed by end of year 1, you will not give effect of this CPI over the lease payment. That means lease payment for year 1 will be 1000, year 2 will also be 1000. However, by end of year 2, the CPI has changed to 108, and because the contract of lease requires the lease payments to be updated at end of every second year, so after end of 2 years the lease payments shall be updated. So the base index was 100 and the updation will be based on the current index, that will be 108. So in place of 1000 as lease payments will be 1000 into 108 divided by 100, and that will be 1080. So let us see how to write up the answer. At the lease commencement date, the lease payments are rupees 1000 per year for 10 years. The entity does not take into consideration the potential future change in the index. At the end of year 1, the payments have not changed and hence the liability is not updated. At end of year 2, when the lease payments change, entity updates the remaining 8 lease payments to rupees 1080 per year. And how did we compute this 1080? I have explained you already. It will be 1000 divided by 100. So 1000 divided by the base index, which was 100, multiplied by current index, which is 108. So 1000 divided by 100 into 108 will give you rupees 1080 per year as lease payments from year 3 onward, until the index change after next 2 years. Anyway, note down this answer and then we shall move ahead. Alright friends, after writing up this answer, let us move ahead and write up a note about those variable lease payments which are not going to be part of the lease payments. So variable lease payments that do not depend on an index or a rate. Variable lease payments that do not depend on index or rate and are not in substance fixed are not included as lease payments. So what you will do instead, these are recognized in profit or loss in the period in which the event that triggers the payment occurs, unless they are included in the carrying amount of another asset in accordance with other Ind AS. So the point is, if the nature of expense is revenue expense, you will charge it off to P&L. If the nature of expense is a capital expenditure and you would want to capitalize that with some other asset in accordance with other Ind AS, as required, you shall do so. So do one thing right now friends, write up these points as well and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us now apply this concept on some case study based questions. So question number 27. Let us read this question. Entity XYZ is a medical equipment manufacturer and a supplier of the related consumables. Customer ABC operates a medical center. Under the agreement entered into by both parties, entity XYZ grants customer ABC the right to use a medical laboratory machine at no cost, and customer ABC purchases consumables for use in the equipment from entity XYZ at rupees 100 each. The consumables can only be used for that equipment, and customer ABC cannot use other consumables as substitutes. The minimum purchase quantity required in the contract is 5,000 units. The question further reads as, based on its historical experience, customer ABC estimates that it is highly likely to purchase around 8,000 units of consumables annually. Customer ABC has appropriately assessed that the arrangement contains a lease of medical equipment. There are no residual value guarantees or other forms of consideration included in the contract. How would customer ABC allocate these lease payments? So friends, in order to analyze the whole situation properly, let us go back to the early part of the question and let us read some important lines over there. Now what is given? Entity XYZ is providing its laboratory machine at no cost, means it is not charging any rentals or lease payments for this purpose. Only condition what it is putting is that the customer must purchase the consumables necessarily from the supplier only, and the supplier will charge rupees 100 for each unit of these consumables. Now the contract is requiring minimum purchase quantity of 5,000 units. What does that mean? That every year the customer will have to pay rupees 100 multiplied by 5,000 units, that is rupees 5 lakhs compulsorily, unavoidably. Now going ahead and observing what is further given, as per customer's estimates, customer is going to purchase around 8,000 units. Now when we say around 8,000 units, it can be something more or less. So if you consider purchase of 8,000 units, then 8,000 units can require a payment of rupees 8 lakhs. But what we have seen, no matter what happens, a minimum payment of 5 lakh will have to be made owing to the minimum purchase quantity requirement. Now that means every year 5 lakh rupees will be considered as the minimum lease payment, which will be considered as a fixed lease payment or in substance fixed lease payment. Any amount payable in excess of cost of 5,000 units depends upon the actual usage of the consumables on year basis. As a result, that part will be considered as a cost which will be charged to P&L each year as and when it is incurred. So we can conclude that rupees 5 lakhs every year shall be the minimum fixed lease payments, and any amount payable for consumption beyond 5,000 units which will be costing some amount more than rupees 5 lakhs, that excess payment beyond 5 lakhs will be considered as an expense for that particular year and will be charged off as an expense in the statement of P&L. So now let us see how to write up the answer. In your answer, you would first mention the fact that there are two components in the arrangement, that is lease of equipment and purchase of consumables. Customer ABC would allocate the payments associated with the contract to lease and consumable components of the contract. As the minimum number of components that the lessee will use every year will be 5,000 units, it is implied that the minimum usage cost, that is 5,000 multiplied by rupees 100, that is rupees 5 lakhs, can be treated as a fixed component of the lease. The balance variable payments on year-to-year basis shall be charged to P&L on actual usage beyond 5,000 units. So friends, please take note of this whole thing, and that will be end of the answer. Alright friends, you would have finished writing this whole answer. Let us move ahead and take up the next question, that is question number 28. Let us read this question. Entity A enters into a 5-year lease of an office building. The lease payments are rupees 5 lakh per year and the contract includes an additional water charge calculated as rupees 0.50 per litre consumed. Payments are due at end of the year. Entity A elects to apply the practical expedient to combine lease and non-lease components. How does Entity A allocate these lease payments? Now this is definitely very simple for you after solving the earlier question. So what we find over here, there are two components. One is the lease of office building and another is the non-lease component, which we find as charges for water consumption. So we can definitely find one thing, that one lease component and one non-lease component included in the contract. However, the nature of this non-lease component is not a fixed payment but a variable payment. They are mentioning that the lessee or the customer, Entity A, elects to apply practical expedient to combine the lease and non-lease components. Even if the entity is willing to use this practical expedient to combine lease and non-lease components, it will not be possible to ascertain the amount, because this amount, whatever will be payable towards water charges, will depend upon the consumption of water on year-to-year basis. As a result, this cannot be part of your lease payment. In other words, when you compute your present value of lease liability, this water charges cannot be part of it for sure. This will be, as and when it is incurred, will be charged off as an expense in the statement of P&L. It is only rupees 5 lakh that will be considered as part of your lease liability for the customer. So let us see how to write up the answer. In your answer, you would first mention, although Entity A has elected to apply the practical expedient to combine non-lease components, that is water charges with the lease component, at the commencement date, Entity A measure the lease liability only based on the fixed lease payments of rupees 5 lakh per annum. Entity A excludes the non-lease component from its lease liability because they are variable payments that depends on usage. Entity A recognizes the payments for water as variable lease payment in profit or loss when they are incurred. So friends, write up this whole thing and that will be end of the answer. Alright friends, I am sure you would have finished writing this answer. If you can recall, we have considered two small components as part of lease payments. One was inclusion of the price for purchasing the asset. That is, if there is a purchase option included in the lease contract, then the price payable for purchasing the asset after the completion of lease should also be considered as part of the lease payment. But there is a condition. What is the condition? Condition is that at the commencement of the lease, it should be reasonably certain that on the date the option becomes exercisable, that is at the end of lease term, the lessee will exercise this option. There should be reasonable certainty in this regard, and such reasonable certainty should exist at the commencement date. Obviously, there may be possibilities that these certainties what exist at one date may change at other dates. In that case, the remeasurement part of the lease will take care of those issues. So, another thing that we have discussed was the amount of penalty payable on termination. So, I have given you examples earlier. Suppose there is a lease of 10 years and the lessee can terminate the lease at end of 6 years, but not freely, only by incurring a penalty of rupees 1 lakh. In that case, what you would do? You have to look into at the commencement date what is the possibility of lessee exercising that termination option. If it is reasonably certain that lessee will exercise that termination option, then the termination penalty should be included. If it is reasonably certain that the lessee will not exercise the termination option, then the termination penalty should not be included as component of lease payments. So friends, these are small simple points which I have talked about earlier as well. Now time for you to write some notes in this regard. So friends, based on what we have discussed about purchase option, that is exercise price of purchase option, if the lessee is reasonably certain to exercise a purchase option, the exercise price is included as a lease payment. Next thing what we have discussed is penalties for terminating a lease. If it is reasonably certain that lessee will not terminate a lease, the lease term is determined assuming that the termination option would not be exercised and any termination penalty is excluded from the lease payments. Otherwise, lease termination penalty is included as a lease payment. So friends, quickly take note of this and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and talk about the next important concept, that is residual value guarantees. Now friends, in any kind of lease, the lessor would obviously expect a considerable value of the asset when the asset is given back to the lessor. That is, by end of the lease term, when the asset is returned, it should have some proper value. And that value will be specified at the beginning or at the commencement of the lease as a guaranteed residual value. That guarantee will be provided to the lessor. That means lessor is assured that even after end of lease term, the asset will not be having zero value, it will have some value depending upon its remaining life, etc. Let me give you an example. Suppose an asset which is newly acquired asset by the lessor and the lessor has given that asset under a lease to the lessee. This asset has a life of 10 years and the lease period is only 5 years. By end of the lease term, out of 10 years of life, only 5 years would have lapsed. The remaining 5 years of life of that asset still is there, and therefore an asset which should have 5 years life, that much approximate value should be guaranteed to the lessor. If the lessor is demanding that guaranteed value, the lessee generally will have to provide that guarantee. Now what will happen? Let us assume that according to lessor and lessee's expectations, the residual value that would be there after 5 years, where both lessor and lessee agree upon, it is suppose 6 lakh rupees. That means at end of 5 years from the beginning of the lease, or in other words, when the lease term is to end, the value of the asset, the proper value of asset should be rupees 6 lakhs. And now the lessor demands the lessee to give that value as a guarantee, and lessee agrees with that guarantee. So what will happen? Lessee's obligation will include the payment made towards this guaranteed residual value. So what happens when residual value guarantee is invoked, what will happen? Lessee will have to compensate to the lessor if there is any shortfall in the value. So, the residual value that was guaranteed was rupees 6 lakhs in our example. Suppose by end of the lease term, when the lessor finds that the asset has been given back to the lessor and the proper valuation made for that asset, the asset could fetch only 5,20,000. That means the lessee has given a guarantee of 6 lakhs, but when the asset was returned in that condition, the way the asset was returned, it could fetch only a value of rupees 5,20,000. So, what will happen now? The lessee is supposed to compensate the lessor not by giving entire 6 lakhs, but by giving whatever be the loss to the lessor. So, that much value the lessee should consider as its liability. Now, at the commencement of the lease, it may be difficult to make an estimate of such amounts payable. However, if there is any estimate possible, then the lessee's liability should include that payment also. So, when you are assessing the amount payable to the lessor under lease, in simple words, when you are assessing the lease payments shall also include such kind of residual value guarantees. So, in my example what I have just conveyed, out of 6 lakhs of expected residual value, if the lessee believes that we will be able to provide the asset back to the lessor at the end of lease term and asset will definitely have 6 lakhs rupees of value, therefore, let us not provide for any residual value guarantee payments. In such case, the expected amount to be paid off under the guarantee is 0. However, suppose after 2 years of lease getting over, lessee estimates that the asset has not been in the right functioning, the asset is not working the way it should have, and there is some deterioration in the value of the asset, and lessee now believes that when the lease term ends, the asset will not be of worth rupees 6 lakhs and certain amount might be payable towards this guarantee. In such case, the estimated amount of guarantee will then be included. That means remeasurement is definitely possible. Now, this is from the lessee's perspective. If you look into lessor's view, the matter is different. In my example, suppose 6 lakhs was the guaranteed residual value and the lessee finally expects that it will be 5,20,000, that the value of the asset that would arise. Then lessee will have to provide for a liability of 80,000 additionally, correct? So, that 80,000 becomes payable from the pocket of the lessee. On the other side, when you are taking lessor's perspective, for the lessor, you should consider the entire guaranteed residual value. Entire guaranteed residual value, because from the viewpoint of lessor, it should be the entire guaranteed residual value that should come in the hands of the lessor. And there may be a possibility that not just lessee, some other party may also provide such guarantee to the lessor. For example, I have made an arrangement of a lease with a lessor. Means I am a lessee, there is a lessor, I have given a residual value guarantee of rupees 6 lakhs. Similar example what I have taken some time back. Now I am the lessee, I have already given a guarantee of 6 lakhs. Suppose the lessor meets a third party, somebody else, that somebody else is promising the lessor, understand the point, the lease agreement was between the lessee and the lessor, but now there is a third party getting involved. The third party promises the lessor that it will pay 6,40,000 towards the asset if the asset is sold to that party by end of the lease term. So, the third party is aware of the fact that initial 5 years I am the lessee, I have taken the asset under lease, and if I give back the asset at end of the lease term, it is a third party which is promising the lessor that it will buy the asset for 6,40,000. Now, I have given a guarantee of 6 lakhs, that other party has given guarantee of 6,40,000. Now from the lessor's viewpoint, my guarantee and that other guarantee payment will be compared. Whichever is a higher value will be considered by the lessor, of course. So lessor is not just affected by the guarantee given by the lessee. Lessor's estimate of the guaranteed residual value will also involve a third party guarantee. So from the lessor's viewpoint, if you see, it could be the residual value which is guaranteed by the lessee, by some party on behalf of the lessee, or by an independent third party which is financially capable of meeting the obligation under such guarantee. So friends, time for us to write down a note about this guaranteed residual value or residual value guarantees, and once you write up that note, we will be solving questions in this regard. Based on what we have discussed about residual value guarantees, let us first take the viewpoint of the lessees. Residual value guarantee is defined as a guarantee made to a lessor by a party unrelated to the lessor that the value or part of the value of an underlying asset at the end of a lease will be at least a specified amount. So what happens when the party who has given the guarantee is the lessee? So from the lessee's viewpoint, what we have discussed, for a lessee, lease payments include amounts expected to be payable by the lessee under the residual value guarantees. Such guarantees are enforceable obligations that the lessee has assumed by entering into the lease. A lessee is required to remeasure the lease liability if there is a change in the amount expected to be payable under a residual value guarantee. So friends, do one thing, quickly note down this whole thing and then we shall move ahead. Alright friends, you would have finished writing this whole thing about the lessees. Let us move ahead and write up something about the lessors that we have discussed. So residual value guarantees from the viewpoint of the lessors. For the lessors, lease payment instead includes residual value guarantees which could be provided by the lessee or a party related to the lessee or a third party unrelated to the lessor that is financially capable of discharging the obligations under the guarantee. So friends, quickly take note of this and then we shall apply these concepts in solving certain questions. Alright friends, you would have finished writing this whole thing. Let us move ahead and take up a question, that is question number 29. Let us read this question. An entity, that is a lessee, enters into a lease and guarantees that the lessor will realize rupees 20,000 from selling the asset to another party at end of the lease. At lease commencement, based on lessee's estimate of the residual value of the underlying asset, the lessee determines that it expects that it will owe rupees 8,000 at end of the lease. Whether the lease payment should include the said payment of rupees 8,000 as a lease payment. So friends, here obviously the guaranteed residual value is rupees 20,000. However, lessee's expectation that the amount that will become payable for fulfilling the guarantee is not entire rupees 20,000 but only rupees 8,000. So obviously the lease payments should include rupees 8,000 towards this residual value guarantee. So let us see how to write up the answer. In your answer, you would first write the fact that as per Ind AS 116, for a lessee, lease payments include amounts expected to be payable by the lessee under the residual value guarantees. So this is basically from the standpoint of the lessee. So in the given case, the lessee should include the amount of rupees 8,000 as a lease payment because it is expected that it will owe the same to the lessor under residual value guarantee. I have already mentioned you one thing, that is whenever there is a change in this amount payable, there will be a remeasurement of lease liability, but we will deal with that later. Right now what you do is write up this answer and that will be enough. Alright friends, you would have finished writing this answer. So time for us to put an end to this session. Let us declare this as end of part 3. Thank you so much for attending this class.